Well, hello everyone. Welcome to our Chapter 7 video lecture. The focus is on how to account for liabilities. So, what are liabilities? If you owe anybody any money, whether it's for credit card payments, student loans, mortgages, car notes, etc., you have a liability. Those are the existing debts or obligations of a business. In chapter 7, we're going to begin first looking at what's called a notes payable. A notes payable is a promissory note, a written document where you have agreed to pay the amount borrowed plus interest at some point in time in the future. So we'll first look at current liabilities and we'll move on to what's known as long-term liability. Now, if a liability is current, this is a debt that will become payable within 1 year or within an operating cycle, whichever is longer. For our purposes, we're going to always use 1 year as the parameter. Okay? Let's take a look at some different type of current liabilities and how to account for these current liabilities. Here we have the maker issues a note. So because the maker of the note issues the note to the payee, the maker is sometimes called the issuer. So the issuer is the person that's actually borrowing the money. Okay? So on September 1st, year one, Herrera Supply Company borrowed $90,000 from National Bank. They issued a notes payable that had a 1 year term and an annual interest rate of 9%. So again, HCS, the Herrera Supply Company, borrowed from the bank $9,000. So this would be the balance sheet for the issuer, which is the supply company. Their cash increased by 90,000. That's an asset. Their notes payable increased by 9,000 because they now have debt on the statement of cash flow. There's an increase in cash for 90,000 shown as a financing activity. Now, we need to show the amount of interest that has accrued on this note by the end of our accounting period. The accounting period ends on December 31st. We first borrowed the money on September 1st. It is now December 31st. You're not paying back the interest, but you are determining the amount of interest that has accrued on this note from the date it was entered, September 1st, until now, 12/31, which is the end of your accounting period. So remember the interest formula is principal times rate times time. We borrowed 90,000. 9% is the annual interest rate. The loan has been outstanding for 4 months out of 12 months. Therefore, the accrued interest totaled $2,700. So on the balance sheet, you'll recognize interest payable for $2,700. Under retained earnings, it would decrease by $2,700 because that $2,700 is known as your interest expense. Okay? Now we're looking at August 31st of the next year. Remember, this note was for the entire year, so the note will become due on September 1st of the next year. So on August 31st in year two, we'll now record the interest for year two. Interest from the 1st of January until August 31st for year two, which is a 8-month time period. You record an interest of 4 months in year one. You record an interest for 8 months here in year two. That interest amount would equal $5,400. So now interest payable increased by $5,400. Retained earnings would decrease by $5,400 because you recognize an interest expense in the amount of $5,400. Okay? So now we're going to make a cash payment in the amount of $8,100, which is to cover the interest payment for that 12-month time period. We're paying the interest owed for the last 4 months of year one and for the first 8 months of year two, a total of 12 months. So the total interest owed is 8,100. So our cash account would decrease by 8,100. Interest payable, because now we're paying the interest owed, would decrease by 8,100. Now your statement of cash flow, you're going to have an outflow of $8,100 shown as an operating activity. Okay. Now it's time to pay back the principal amount, the amount borrowed, which was $90,000. So when you pay the note back, your cash would decrease by 90,000. Your notes payable account would decrease by 90,000. On your statement of cash flow, there's an outflow of cash 90,000 as a financing activity. So now you pay back the 90,000 borrowed along with the accrued interest in the amount of $8,100. Next up, how to account for sales tax liability. Okay, let's assume that you are a retailer. You have your own store. So when your clients come in and buy products, you're going to charge them sales tax. Now listen carefully. That sales tax does not belong to you. You're just a collecting agency for the state in which you operate in. So if you're in the state of Missouri, you're collecting sales tax on behalf of the state of Missouri. At some point in time, that sales tax you collected will be paid to the appropriate state authority. Okay? For example, let's say that we sold merchandise at a cost of $2,000 plus sales tax. Our sales tax rate is going to be 6%. So you will multiply 2,000 times 6% to get the amount of sales tax, which would be $120. So the total cash collected was $2,120, but notice you have sales tax payable, which is a liability for the $120 because, again, the sales tax collected does not belong to the retailer. You are just a collecting agency on behalf of the state. So we'll recognize retained earnings of 2,000 because you had revenue of 2,000 from the actual sales. On your statement of cash flow, you have an inflow of cash of 2,120 for the amount collected from the actual customer. Now, when it's time to remit the sales tax, it means you're now paying the sales tax owed to the appropriate tax authority. So when you're paying the sales tax, now your cash account will decrease by 120. Your sales tax payable account will decrease by 120, and you will have an outflow of cash on the cash flow of 120 shown as an operating activity. So once again, if you are selling products and you're charging sales tax, the sales tax does not belong to you. You're just a collecting agency on behalf of that state. Okay? All right. Next up, how to determine or not determine, define contingent liabilities and how are they reported on the financial statements. So first of all, what is a contingent liability? Well, this is a potential obligation arising from a past event. The amount of existence of the obligation depends on some future event. For example, let's assume that a company is being sued. They're currently going to court because of this lawsuit. That could become a contingent liability. It is based upon the outcome of the future event. Now, if the likelihood is probable, meaning that it is probably we're going to lose this lawsuit, and the amount of the loss can be recognized, then we have to record that on our financial statements. Now, if it is reasonably possible, but not likely that we can lose, but we cannot reasonably estimate the potential liability, so we like saying, well, it's reasonably possible that we could lose this lawsuit, but it's not likely that's going to take place. But we're also not sure of the actual amount of the liability. Then we're going to disclose this information in our annual report. So it's not going to go in our statements, but we are going to disclose that information on our annual report. If it is remote, meaning it is unlikely that we're going to lose this lawsuit, then there's no need to recognize on our statements nor disclose that information. So as you can see, this is very subjective. So if it is probable that we're going to lose the lawsuit and the amount of loss can be estimated, record the amount on your financial statements. If it is reasonably possible that we could lose, but not likely, but the amount of loss cannot be estimated, just disclose, tell about the lawsuit information as part of your annual report. If it is remote, meaning it is unlikely we're going to lose, then there's no need to disclose it nor report that information on your financial statement. So this is just showing the information, how you will handle that if it's probable and estimated, the loss. If it is reasonable, but the loss cannot be estimated, or if it's remote, this tells you how to handle those different types of contingent liabilities. Okay? Next up, we look at the impact of warranty obligations on the financial statements. So we're saying when you buy a product that comes with a warranty that guarantees they replace or repair that item, we'll take a look how do companies account for those warranty obligations. Here we have the company sold merchandise for 7,000 cash that had cost us 4,000. So the company HSC sold 7,000 of merchandise for cash that had cost us 4,000. So our cash account increased by 7,000. Retained earnings increased by 7,000 because you recorded revenue of 7,000. You have an inflow of cash of 7,000 shown as an operating activity. Now, because you sold inventory was going to decrease by 4,000. Retained earnings would decrease by 4,000 because your expenses will increase by 4,000. Once a product has been sold, the cost of that product is now recorded as an expense. Okay? Now, the same problem came with a guarantee to be free from defects for 1 year following the date of the sale. So, as a company, we have to estimate the amount of that warranty obligation. And we're saying that amount is going to be $100. So we're saying based upon prior experience, if we have to repair this item, the estimated cost would be $100. Now, this hasn't taken place just yet, but we still want to estimate what we call the warranty expense and the warranty payable. So the warranty payable account or liability will increase by 100. Retained earnings would decrease by 100 because you're recognizing what's known as your warranty expense. Now, what if we actually paid $40 to repair a defective merchandise? When that takes place, now our cash account would decrease by 40,000. The warranty expense, the warranties payable would decrease by 40,000. On your statement of cash flow, there's an outflow of $40 shown as an operating activity. Okay? And here we see the financial statements to cover those transactions for year T to the income statement, the balance sheet, and the statement of cash flows. Okay? So stay tuned for part 2 of our Chapter 7 video lecture. Bye-bye.